Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So let's get to that consumer confidence data. So overall, as Paul and John were talking about, coming in at 106.7, that is lower than January, and it also missed. Present situation not looking as great either, 147.2. The expectation number coming in at 79.8. So Dana Peterson is chief economist over at the Conference Board. She helps to get through all this data. Hey, Dana, what should my takeaway be from these numbers?
I think the key takeaway is that the numbers are still pretty range bound. We haven't seen a breakout in confidence to the upside yet. We did see a dip in the measure for February, and January was also revised down. I'm sorry, for January, and then December was also revised downward. And certainly in this month reading, we saw that both expectations and current conditions were weaker. And importantly, when we ask consumers about recession, that expectation ticked up a little bit after falling pretty steadily for many months.
So what do we take here? I mean, when we look at this consumer confidence data points, how do you guys look at it? What's a reasonable time series for you guys?
Well, we look at it as a whole. There's a lot of information in there. And certainly when we look at the details, consumers were a little less optimistic about employment and business conditions right now. They also complained about their finances not being as strong currently. Also looking ahead, consumers were pretty unhappy about employment, business, and income, and their financial situations. Their expected financial situations were also a little bit worse. So we're still kind of just moving back and forth in the data. But I think some key things in the write-in suggest that consumers are a little less concerned about food and energy prices. And certainly we're showing that the expectations gauge continues to decline. So that's all good news on the inflation front. But they are more concerned about jobs going forward. And they're also more concerned about the political climate. And so we'll be watching not only the inflation gauges, but also the jobs gauges within this. Because if consumers get the whiff that more layoffs are coming, then they'll pull back on spending, and that'll contribute to slower growth over the course of this year.
What are they still spending on, and what have they now avoided?
Well, consumers are definitely still spending on services. We see that in retail sales. We see that in the consumer spending data that the BEA puts out. But when it comes to goods, they are starting to pull back on things that require financing. So homes, cars, big ticket appliances, and that's because interest rates are high. And indeed, in today's report, consumers said that they don't expect interest rates to continue falling. They think interest rates might actually tick up. So that's pretty material when it comes to their buying attitudes for goods. But certainly when it comes to vacations, we did see a little bit of a pullback in expectations about going on vacations, but that's just one aspect of services. And we're really going to need to see the PCE data this Friday to see about whether services consumption is still pretty robust in the United States.
Talk to us about the labor market and how that impacts consumer confidence. I would think that would be a big one, because it seems like everybody who's got a job has a job and wages are going higher. So that's got to be helpful.
Yes. I mean, when we look at payrolls, we saw really shockingly, surprisingly strong numbers in January and December. And it wasn't just kind of your big three driving things. The big three are leisure and hospitality, government, and also healthcare and social assistance. You saw gains across the board. And you also saw an uptick in temporary employment for the first time in a little over a year. So those data are pretty good, but we need to continue to see improvement in the labor market, or in terms of the gains being more broadly based, or else we're going to see weakness ahead. Indeed, you still do have some industries that are letting people go. Certainly finance, tech, transportation, and warehousing. We don't think that's really going to improve. Also, residential construction's probably not going to improve until interest rates start to fall more materially. So we're definitely watching the labor market. We think there will be weakness in the U.S. economy, slowing down probably around 0%, between 1% and 0%. a little bit of an uptick in the unemployment rate before the end of this year to 4.3%. But then we'll see things get better towards the end of the year, certainly as the Fed we think will have begun cutting interest rates probably starting around June, and then we'll cut interest rates further next year.
So they're looking at sort of prices, everyday prices, to sort of give them a read on inflation. They're looking at their job status to feel good about that. What other factors do they wind up looking for? Like, is it, I'm going to go buy a car and I don't like a 5% interest rate? Is it the mortgage rate? Is it the stock market? I know that the stock market's not the economy, but if you have a 401k, you've probably been pretty happy with what has come through in the last year.
I think consumers are looking at all of that. And certainly we've seen that consumers have continued to spend. But some of that spending is deficit spending. They're using credit cards. So that means that, their real incomes are probably not rising as much and certainly is below the real spending that we've seen. And this isn't really sustainable. But again, as many consumers are working, they still feel confident that they can put expenditures on the credit card and they'll be able to pay it off. But the thing is that if you fall behind, and we are seeing delinquencies rise, the cost of that credit has skyrocketed. And indeed, when you look at the amount of interest that people are paying in the PCE data on debt, it's skyrocketed along with the amount of consumer credit card debt that's piling up.
In terms of future expectations, the Conference Board expectations came in at 79.8 last month versus last month, which was revised down to 81.5. Where would you like to see that? Where would economists like to see that number?
Well, I mean, the thing is that people always say economists are dismal scientists, but really we are optimistic. And, anything above the 80 threshold signals that consumers think the economy is going to continue to expand. And that's always a hope among economists. But, this measure has been over and above 80 over the last few months. And certainly the uptick in the percentage saying that they think a recession might be on the horizon is disconcerting. So we want to continue to watch the data and see how consumers feel in line with the real data that gets pumped out by the government. So certainly we want to see better growth, but we see tremendous risks to the downside.
All right, Dan, thanks so much for joining us. Dan Peterson, Chief Economist at the Conference Board.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go to Macy. So that stock is now up by 3.6%. They're closing about 150 namesake stores. Certain areas like Blue Mercury did pretty well, which, as I keep telling you guys, invest in your face is a thing.
Okay, but I think it's the time has passed for John and I.
No, it's never too
I
late to invest in
went
your
into
face.
one of these stupid stores with my daughter.
Oh, boy.
She wanted, whatever. The margins on these things must be incredible.
Yes.
I'm like, there was $80.
And
for
they
this
never
thing.
go on. You don't even want to know what I spend on my skincare, but they never go on sale. You just have to take it, and you can see that through Macy's numbers for Blue Mercury. Anyway, Mary Ross Gilbert is going to help me out here. Bloomberg Intelligence Senior Equity Analyst covering retail. Okay, Mary, what did you make of Macy's quarter, and do you invest in your face?
Of course I invest in my face. That's why beauty has been the outperformer for almost anyone who announces, including when Dillard's came out with their numbers yesterday. So with Macy's for the quarter, they beat their estimates on sales and on earnings margin, so sort of across the board. But the focus really wasn't on how they did in the fourth quarter. It's really their new plan. That was the big focus, the new plan and their guidance for the year. So their guidance came in softer than consensus. And I guess it's just no surprise, just thinking about how department stores are under pressure. And we've seen it across the board with, again, Dillard's showed some weakness yesterday. We're seeing it with Macy's in their outlook. But Macy's has a plan to address the department store model in shuttering 150 underperforming stores, and then they're going to invest in the 350 remaining. And those are going to be primarily in A and A++ malls. And what they're going to do is increase the service levels. Beauty has been something they've been investing in almost every year and expanding the floor space dedicated to beauty. So you'll notice that if you walk into Macy's, you'll see that they have expanded the space, and who knows, they could expand it again this year. We've been seeing it for the last 5 years that space has been expanded. So there's a lot of details in what Macy's is doing. It's something they need to do. They really need to up their game, and that's exactly how they started their presentation. And that includes really making the assortments a lot better than they are. Because if you look at the inline store performance at malls, they're the ones that are executing, such as the Abercrombies, the Urban Outfitters, they're outperforming.
So, Mary, I was kind of surprised to see this number of stores, 150, because I kind of thought that this decade-plus long shrinkage of department store footprints across the country by a lot of different companies, that was more or less kind of we're done that, or we're at near the finish line. So to see another big round of closings, that kind of surprised me. Did it surprise the market at all, or is this something that analysts and investors have been asking for?
What Macy's had said is we don't need to close stores except for the usual stores that you close every year, which is maybe less than 10 per year. But the reason that they've decided to close them is because these stores were underperforming, but they were still profitable on a four-wall basis. So historically, their thought was, well, if it's still profitable and we're still generating cash, we'll keep it open. And this time what they did is they took a more holistic approach and said, okay, even though it's four-wall profitable, we could do a lot better with the funds that we could generate closing these stores, selling the real estate, and redeploying it back into the existing store base and for all the initiatives that they have going forward. It makes a lot of sense because let's face it, we really need to rethink the department store model. It has to evolve.
Mary, does this do enough to get activist investors off Macy's back?
That is a good question. I think it may. I think the board has made it very clear that they are supporting this plan. Could they enhance the board with additional directors? That could be a possibility. So we'll learn more about that in the coming months. But I think that this plan it's been decided that this is the move forward. And when you think about what's happening with the activists, it usually involves the real estate. And what we have seen in past transactions is the real estate is usually milked, and it can be to the detriment of the retail operations. And so sometimes it's not always the best move. So Mary, but they do have valuable real estate here.
Talk to us about like a relative performance between like a Macy's store and a comparable Bloomingdale store. Is the Bloomingdale store materially more profitable, I guess?
Yes, they don't disclose the profitability on Bloomingdale's versus Macy's, but Bloomingdale's outperforms, as does Bluemercury. This year, their comp sales were down 1.6% because the aspirational luxury consumer is spending less. And we've been hearing about the overall luxury business being impacted, especially after we came off the post-pandemic spending from stimulus checks that really had that aspirational customer going after luxury. So now that that's kind of, falling back, we're seeing more of a normalization. This is something Nordstrom also cited. So their sales were just down 1.6%, but they think that could probably stabilize and go higher next year. And of course, with the beauty side on luxury, that's posting positive comp sales. So that's stronger.
Yeah, Mary, I was going to ask about then the inventory. Macy's notoriously last year struggled with inventory. The last quarter we saw they really got it together. What did we learn this quarter about their inventory?
Yeah, so even though inventory was up 2% year over year, it's still down over 20% versus 2019. So they've really done a great job reducing their inventory, and that means that they're having less clearance activity. This is something that's going to affect their first quarter. Because last year they had more clearance and this year less. So they're doing a great job overall. They've just been improving their execution with data, technology, logistics, and they talked about that on the call. They're going to be even employing some generative AI. They've already been employing machine learning. So we'll see more, and they're going to be streamlining operations. We didn't talk about that, but they're going to be consolidating some of their facilities. So they've reduced layers within the management structure. So overall, simplifying the operations. So all of these things could restore positive growth in 2025.
Mary, who's the retailer out there that you think is doing the best job?
Of all of retail, or just within the department store space?
Just kind of within your coverage, because you cover a broad range of the retailers.
Yeah, so I think that what we're seeing right now is some of the inline specialty retailers are doing really well. If you look at what Ralph Lauren has done, Ralph Lauren is outperforming. But what they did was they sort of retrenched the business. They do supply to Macy's and other department store retailers and with their wholesale business. But what they did is really focus on DTC, direct to consumer. This is something other brands have been doing as well. But Ralph Lauren cut back on off price. They cut back on wholesale. They elevated the product, so it's much higher quality. And then they've elevated the overall consumer. Mm-hmm. And so it's much more of a luxury brand now. But they also do have, some aspirational brands in their portfolio, like Ralph Lauren, which you'll find at Macy's. And then you'll find Polo Ralph Lauren and Double R Ranch in their Bloomingdale's concept, for example.
Hey, Mary.
So I think that Ralph Lauren's a good example.
Mary, we appreciate it. Thank you very much. Mary Ross Gilbert, Bloomberg Intelligence, Senior Equity Analyst. But my point is that, what if you can get men really invested in skincare?
Oh, man, that'd be
He's not
huge.
putting makeup on, is he?
No.
Okay.
He's
Just
investing in his face.
Investing in his face. That's what it is.
When you become a certain age, Tucker, you got to do that.
At what age would that be?
Now. Anyway, you're listening to Bloomberg
Irish
Intelligence. Do you? That's not good.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Hess is down 3.25%. It's one of the worst performing stocks in the S&P. Chevron is also off by 2%. Here's the interesting reason why. So Chevron had a filing that came out late last night that said one of their risks about its takeover of Hess is actually the fact that Exxon and Cnooc, which are partners with Hess in Guyana, say they have the right of first refusal for Hess's portion of Guyana, which basically means that Exxon and Cnooc, which is a Chinese oil company, could bust up this merger between Chevron and Hess. So for nerds like me, this is cool.
That's big.
This is stuff that's happening. So for that, I turn to Fernando Valle. He's Bloomberg Intelligence Senior Oil and Gas Analyst. Fernando, when we think about these mergers, we think about, competing bids. We think about antitrust. We think about those things. We didn't think that this was going to happen.
Yeah, typically you don't see preemption rights on corporate takeovers. It's very rare. You saw it recently when Suncor acquired TotalEnergies Canadian subsidiary, and there are some preemption rights there on ConocoPhillips acquiring 50% of Surmont. But typically, you're acquiring the whole company, and the owner itself doesn't change, just the controller of it. So most joint operating agreements don't foresee for that to be a preemption right event.
So what does the contract say here? It's got to be cut and dry. If I'm Chevron and I'm buying Hess, I have to have a high level of confidence that I'm going to get the Hess stake in Guyana.
Well, all we can do is speculate because it's a private agreement, so we are not really privy to the details of that contract. Hess seemed to be very confident that they will be able to push this through, and there is no preemption rights. I would argue that Guyana is the most valuable asset in Hess's portfolio. I think most people would agree with that. And so, as Alix mentioned, if Guyana was excluded, then likely there's no deal for Chevron anyway. And so I doubt that that we'll get clarity in the next few days, but Hess seems to be fairly confident there is no preemption rights in this case.
So why is why is Exxon doing this?
Well, because it's the second best asset in the world.
So why doesn't it just buy Hess then?
Because they don't want to buy everything else that's included with Hess. They want to buy Guyana. And
so why didn't they do this before Chevron got into this?
Probably because Hess wouldn't want to sell just Guyana. And now Chevron has laid out the marker, the pricing marker for it. And if you can just find a way to just pull out the best asset out, why wouldn't you?
So this is an exercise for the lawyers here. Who's got the better lawyers? I mean, that's what it comes down to. Do we have any sense as to when we're going to get some visibility here?
Probably within the next month or two, I would expect some visibility. It does tend to drag on. With Conoco, it took upwards of 2 months to see the actual preemption, and then to find over 6 months to get a new deal between Suncor and Total Energies. But I think probably within 2 months we'll get more clarity on this. It's really about the contract at this stage, and if they were negotiated at a suitable way for Hess and Chevron back when the joint operating agreement was signed.
How much of a bummer would this be for Mike Wirth at Chevron if this deal collapsed?
I mean, this would be huge. This is, as I said, the second best asset available for sale, and really that's the only block that has any production out of Guyana and any real potential as it stands. So if they lose out on that, it's a big part of the growth opportunity for Chevron, and it puts Exxon in a whole new level because now they would own upwards of 60% of that asset and give them a lot of growth over the next decade. You don't spend $60 billion on Hess if you don't think that Guyana is a very, very attractive development over the next 10 to 15 years.
Yeah, and to your point, it's not like they can just go buy the next asset, right? Like it's not like they're vying for areas in the Permian where there's a ton of producers where maybe you could look at different acres somewhere else. Like this is kind of a make or break it moment. If the deal does go through, then what's the relationship between Chevron, Exxon, and Cnooc going to be like, since they all sort of are working in the same area, working together?
I mean, they work in a lot of projects together. They are in Tengiz, Chevroil, or in Kazakhstan. They are in Wheatstone in Australia. They've been partners for a long time, and I think there's no love lost there. There's always going to be a competition, and if you can exercise your rights, fair play to you. Obviously, They won't be totally happy with it, but I just can't foresee. You have to be fairly sanguine in this industry, and you have to move on to the next deal and to the next growth possibilities. So I'm sure it will be hurtful at first, but you got to find ways to keep working together and do best for your shareholders.
That's awesome. Hurtful. It will be hurtful. Hey, just looking at the share price, Hess off over 3%, Chevron off by 2%. Are these legit reactions here?
Well, I think yes, in the aspect that, again, it's the second best asset after Pioneer, and if there's a movement where Exxon consolidates those two best assets, and it's really painful for Chevron. And then for Hess, if you sell just your best asset, you take the diamond out of the rest. The rest of the portfolio is a much harder sale.
All I know is if I'm Chevron, I'm turning to my lawyers and I'm saying, tell me we're covered here.
Yeah.
I mean, tell me this is not a risk. I can't imagine that this is even something that would be talked about. Is this something that happens in other deals?
Well, as I mentioned, it happened with Suncor buying Total Energies in Canada. It was a little bit different because the Surmont mine was only Conoco and Total, and Conoco managed to preempt that. I'll say that Suncor, in Suncor's release saying that they were acquiring Total, they noticed right away that could have been an issue in Surmont. Mm-hmm. So as opposed to Chevron did not say that as a risk in their initial filings.
Which is interesting too, because if you take a look at some analyst notes out that also came out today, it's like, look, either way, it'll be fine. Let's just say it's going to take a lot longer for the deal then to get closed, which just makes everything just a little bit more uncertain. The synergies, the development, etc. Fernando, thanks a lot. Always love talking to you. Great to see you. Fernando Valle, Bloomberg Intelligence, senior analyst for oil and gas. He's like my go-to guy.
Yeah, he knows what's happening. Global energy. He's our guy.
Global.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Exxon and Cnooc are trying to prevent Chevron from taking over Hess because of the Guyana asset. They're trying to sort of get the rights of first refusal. That's interesting. We're seeing a lot of natural gas deals getting done. We're also seeing natural gas prices continue to tank, like under $2 MMBTU is really tough for some of these producers. So we want to get a broader perspective on how to invest. And Haag Sherman is Chief Executive Officer and Chief Investment Officer over at Tectonic Holdings. Now, he is a big deal in the energy space. He manages about $6.7 billion across all asset classes, not just energy, but he was the guy that you go to for this kind of energy advice and energy investing. Haag, it's great to have you. Thank you for joining us. There's a lot to talk about. What is foremost on your mind when you think of investing specifically in the energy space?
Well, I think foremost on my mind is really the consolidation that's going on in the industry. So if you look at both oil and natural gas, you have some major transactions that have been inked. You just mentioned one, which is the Chevron Hess deal, which is being attacked effectively by Exxon based on their right of first refusal on the Guyana assets of Hess. But you also have in natural gas, you have the Chesapeake Southwestern transaction, which is similarly very interesting. So I really think this is the central thesis of energy, which is we want to have more scale in the basins in which we operate because we're really in the manufacturing business. We're manufacturing molecules. So scale, operational efficiency, and inventory matter.
Hey, Haag, I hear, I have a lot of buddies from my Payne Weber day. I know you were there, David Bradshaw and a bunch of other guys that were in the energy space. What I know is from them, E&P was the fun sector to cover there for a while. But I get the sense that these E&P companies aren't doing too much E these days. They're just kind of in production. Is that the case, and why is that?
Good question.
That's exactly right. So if you look at historically, as we grew up, especially here in Houston, the E was kind of the glamorous part of E&P. I mean, you had these great offshore projects. You had, these frontier projects, the North Slope. When Russia opened up, you had the Sakhalin Island. You had Kazakhstan, and you had other projects. And this was really the glamorous part of the industry. And our oil and gas companies were intrepid. They would invest, but they also had a long time horizon. Today, that time horizon is much, much shorter. With the onslaught of renewables, the executive teams of these big E&P or these big energy companies are more focused on delivering short-term investor returns, delivering cash back to investors. They don't want to take duration risk. So they're really focused on becoming manufacturing businesses with good core holdings and good inventories of areas of current operations.
So how do you invest in that when they're becoming a different type? It's becoming a different type of industry in essence.
Well, I think you really focus on those that are best at manufacturing the molecules. I think Exxon is an excellent, and they've really been on this trend for quite some time. They had a big 2019 initiative to cut costs and really become more efficient. EOG is another kind of a mini Exxon without the downstream operations, very efficient. They understand that this is about inventory, unit level cost, unit level productivity, and economies of scale so that they can deliver the best return possible to their shareholders.
Hey, so you're right there in Houston, the center of the U.S. energy business, maybe the global energy business, I don't know. Talk to us about renewables. How committed, to what extent are U.S. energy companies kind of committed to renewables? Because some of the rhetoric coming out, I don't know if it's just politicians or others, or I'm just not sure. It seems like it's more commitment out of some of the European energy companies.
And I think that's right. I think if you really look at the big integrateds in the U.S., there are certain areas that they're focused on, carbon sequestration and other areas. But to their credit, they've been focused on what their core competency is, which is producing hydrocarbons. And if you look at Europe, which you brought up, BP's under a lot of pressure now for abandoning hydrocarbons, or at least de-emphasizing hydrocarbons. So I really think that the U.S. energy companies got it right. But we have other areas of investment, particularly here in Houston and Texas. Texas is a U.S. leader in renewables. We have great private equity supported the industry here in Houston and throughout the state and really throughout the country. And so we're getting that built out independent of our E&P companies or our energy companies.
So Haag, as I talk about how to invest, it's really going to be private equity, it's government money, and it's oil companies. Like those are three buckets that I see that invests in the energy transition, not just straight renewables, but the energy transition. What in the energy transition do you like the best? There's so much money that's going to be wasted on stuff that doesn't work. What do you like?
It's a tough space to navigate right now, because if you really look at kind of renewables right now, and really over the past couple of years, it's really like the shale boom back in, call it 2013, 2014, 2000, before it crashed, because there's a lot of money that's coursing in. Prices are inflated. So to me, it's really an area that you have to be careful in, and that's why I like, fossil fuels better at this moment than energy transition, just because I think the prices are better, and if you're a share or an investor looking for returns, you want to go to where you can get the best returns. So I've shied away from renewables, really focused on traditional fossil fuel energy, but the day will come when those will become more investable, in my opinion.
I'm looking at this chart for natural gas. What happened? Holy cow. Things cratered. I thought people liked natural gas.
People like natural gas, and consumers like cheap natural gas.
Yep.
It's not great for producers, but it really is. It's a stunning collapse. I mean, if you look a year and a half ago, you were at $9 per MCF. Today it's $1.80 or thereabouts. And so it's been a stunning collapse. A lot of it's weather driven. You had a big LNG facility that was offline that really started, it was a catalyst for the current downdraft. And right now, we can talk about natural gas being a global commodity, but right now it's still largely a domestic commodity. So we really don't have the global support until we start opening up more LNG facilities, which will happen in 25 and 26. If you look at the curve in 25 and 26, it's more constructive, although it's not great.
So, but to that point, I mean, with natural gas prices at this level, are they economic for producers and for LNG exporters?
For producers, it's tough. So, I mean, a lot of them are hedged. And so, for example, I think Chesapeake's 44% hedged.
Okay.
So a lot of them are hedged in a higher price environment. And so they're still getting by. But if you look at really what Chesapeake announced last week was, we're not going to invest as aggressively in the space. And so that created a situation where natural gas got a modest bid, but all the energy companies in natural gas saw their stocks rally. There has to be this sea change within natural gas production where rigs are laid down, and that'll happen to a certain extent through consolidation. That's why the continued consolidation in the industry, taking privates out because they've been more active with the drill bit, and public companies have certainly been more disciplined than private companies as it relates to producing or drilling wells.
Haag, thanks a lot. Really appreciate it. Haag Sherman, he joins us, CEO, CIO of Tectonic Holdings. He joins us from Houston. In the case of Chesapeake, for example, buying Southwestern, they also just are basically leaving the natural gas in the ground. But then in a moment's notice, when natural gas prices tick up, they're going to go and explore it. So they have the reserves around to do it. They have the equipment to do it. They have the know-how to do it, but not everybody does. So
do
that's
we know,
a different thing.
Oil, I understand it's like $40 to $50 per barrel cost roughly to get it out of the ground. Do we have what's the number for nat gas? Do we know?
I don't actually know.
So I'm wondering at $1.67 whether it's economical to.
Yeah, I don't know that. The hedging question was a good one for him. But I also think that I've been talking to LNG exporters. Under $2 is really hard. Right. It's really hard to make that export number work for them. So I think that's interesting too, particularly with the moratorium, et cetera, how that winds up playing out.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Ira Jersey. He is a Bloomberg Intelligence chief U.S. interest rate strategist. So I care because yesterday we had the 2, we had the 5. We had record corporate bond sales, and we had a pretty solid takedown. I mean, there's a lot of supply. Overnight, we had a really strong demand for some French issuance. Come on, buyers are there.
Yeah, I think given where yields are and just the idea that we are getting a bunch of mixed data, that there are some people dipping in their toes. And keep in mind, going into the most recent sell-off, it seemed like the market was positioned a little bit on the short side. So if nothing else, you're going to wind up continuing to see some short covering. Talking about the auctions, the two things that we look at very closely in the auctions is that bid to cover ratio. If it's basically at or near where it has been historically, that's actually a pretty good sign because these auction sizes are much larger. So that means that you still have bidders who don't have to come in and bid. So these are bidders that aren't just the primary dealers that are coming in and looking to buy some bonds. And you saw that a tick up in the bid to cover ratios in some of the auctions in the last couple of weeks. So that's number one. Number two is indirect bidders. So indirect bidders are people who go to dealers, put in their orders, and they're end users. So those are hedge funds, pension funds, investment managers, mutual funds, and the like. And so that is the end user demand, and the higher that is, the better. So again, we look at the trends in that. So those are the two things: bid to cover and indirect bidders. Those are the ones you want to key in on.
See,
I learned something
he
there.
cares.
Yeah,
John
right.
Tucker, bid to cover ratio.
That's what I said.
That's what he's been doing this 30 years. He's learned one term, bid to cover ratio. All right, so is the market also positioned, Ira, for kind of a hot inflation data point on Friday?
Yeah. Well, so the data that we're going to get this week is the PCE deflator, and obviously that's the Fed's primary gauge that they look at and that they want to try and target when they talk about inflation. I think that the market is expecting somewhat of a better number or higher number than we had in the recent trend, and it does broadly follow CPI. There's different weights, but generally speaking, whatever CPI does, usually PCE does that, at least directionally does the same thing, maybe higher or lower magnitude, but usually the same. So I think investors are currently expecting inflation not to be coming down as quickly as it had been last year, and that's one of the reasons why we have 10-year yields at 4.25% instead of under 4. Right.
And then
that was one of the big reasons for that.
And then hence like the short positioning, and then now the short covering. So are we going to come in more clean in terms of positioning for the PCE?
Yeah, it seems that way. That I still think that people are leaning at least a little bit on the short side. There were a lot of people who were long the front end of the curve and short the long end. So you had people in what we call yield curve steepeners. So people who thought that short-term interest rates were going to go down more quickly. That's really been the big unwind. It's been the unwind of this curve trade that has driven things significantly. So we talk about 10-year yield at 4.25%. Look what the 2-year yield has done, right? You have it all the way from just over 4% all the way up to 4.70, which implies that the market's thinking the Fed's only going to cut 6 times over the next 18 months or so. So that's pretty impressive that we've come back and basically priced out 2 full rate cuts over the next year and a half, and I think that that's a very telling positioning shift that we've had in terms of the curve. So I think, yes, people are leaning short, but also curve positioning is probably much cleaner now than it was before, which is the reason you saw a semi-decent 2-year auction yesterday.
So the 10-year Treasury, Ira, is about 4.28% today. Where do you think this is towards year-end?
So year-end, we still think that we're going to see a pretty significant rally in the Treasury market. So that means price up, yields down, so we do think that we're going to see somewhere south of 3.5%. Over the next 9 months or so, and the primary reason for that is that over time we do think that the economy is going to slow. You are going to get rate cuts, priced into the market and the Federal Reserve actually acting on that. It doesn't seem like it now, but over the course of the year, there are some cracks in the economy. They just haven't manifested themselves yet in some of the hard data. But you look at even the consumer confidence numbers that we just got a couple of minutes ago, and that was a pretty big downshift, both in the current expectations and the headline number. So that doesn't mean that people are going to stop spending tomorrow. tomorrow, but it does suggest that if we continue to have, slightly better or higher inflation prints, and you have people who are worried about the political angst, and you also don't have people getting the raises that they were getting over the last couple of years, that all of those things can contribute to a slowdown in spending, lower inflation, and therefore interest rate cuts, and that's why long-term Treasury yields could rally a bit by the end of the year.
So Ira, I'm looking at a chart, not normalized, of the 2-year yield and the S&P, and I know you're the bond guy, but the peak that we saw in yields for the 2-year back in October, marked sort of the interim bottom for the S&P and sort of ignited that bull run that we've seen since then, where the S&P is up, 23%. If we keep grinding higher here on yields, like at some point, that's got to wind up denting the equity market, no?
Yeah, I would think that the way that risk assets have been acting recently is that if the Federal Reserve is not cutting interest rates, then valuations are much too high, right? So that's what you saw back September, October, when you wound up having, us actually pricing in the potential and serious potential of hikes this year or over the course of the 18 months following that, and that I think was really driving some of the equity valuations and the fall thereof. I think the question is now, and this is where the uncertainty about what's going on in the economy really comes into play and into how you position your portfolios, is that if the economy is good, and that's the reason why we have interest rates that are relatively high, that's not necessarily bad for equities. That doesn't mean that equity markets necessarily can go up or need to go up, but it doesn't necessarily mean that they need to fall either, because if you continue to have good top line growth, you can hold your profitability where it is, then then it becomes a valuation story, not a fundamental story for, I think, companies more broadly. So I think interest rates are there will be shifts in how the different markets react to each other, where that negative correlation you saw back in October might actually turn positive and be positive over the next 6 to 9 months.
All right, Ira, thank you so much. We appreciate that. Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence, dialing in from our Princeton studio.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.